In this video, we're going to talk about profitability, which is one of the main ratios and one of the most important regarding the financial situation of the company. Profitability expresses a relationship. The relationship between the profit of the company, the one that we call the economic result. Remember when we were doing the chart of the payment, expenses, and cost, there was an economic result, okay? And the capital that the company invested to get that economic result, that profit. It measures the financial efficiency of the company, and we measure it in a percentage. So the result is going to be 2%, 10%, 20%. Okay, we're going to get a relationship in a way of a percentage. However, when we talk about relationships, what we're talking about is a division. We're going to divide the profit between the capital. However, there are many profits. We can use the gross profit, net profit. We can use the economic result as a profit. We can use the profit before interest and taxes. And there are also many interpretations of the capital. So we can use the equity. We can use total capital, which means equity plus external capital. We can use the capital invested in order to sell the products. We can use the capital invested by a shareholder. So there are many different interpretations about the capital too. Depending on the interpretation we take on each one, the profit and the invested capital, we will get a different profitability. Let's see now the different results or profits that the company can calculate. They are all in the profit and loss account. So what we're going to see are all the concepts that belong to the profit and loss account according to Spanish regulation. First thing we have are revenues from operations. This is what we have called sales incomes. To this, we're going to subtract the cost of materials, and this is what we have called the raw material, other materials, etc. We're going to add other incomes. This concept has appeared in a few exercises, and it's related to those services, additional services that sometimes the company provides apart from the main business they are dedicated. We will subtract now employee expenses, which are salaries and the social security, and other expenses such as marketing, the electrical power, water, all those other expenses we have been working with. This is equals to EBITDA, which is earnings before interest, taxes, depreciation, and amortization. We will subtract depreciation, only the legal depreciation, and this will equal to EBIT. EBIT is an intermediate result we have not seen yet. It's not in the cost, expense, and payment chart, okay? So it's an intermediate thing. It's not the economic result, it's not the internal result, it's not the monetary result. It's a different one we have not seen yet. Now it's time for the financial part. So we're going to have a financial incomes, and these are the financial earnings of the company, because remember, there were some financial investments that the company was doing. This is in the assets, in the financial part. So the company is earning money. They are getting financial interest, they are getting dividends, they are getting some financial things, okay? So these are the financial incomes. And we're going to subtract the financial interest, the financial expenses, sorry. And this is the financial interest we have talked about before, and this is related to the loans. It's the financial cost of the debts the company has. So if we do the financial incomes minus the financial expenses, we have the financial profit. If we take the EBIT and we add the financial profit, we get what the company calls gross profit. And this is what we have already studied as an economic result. Remember, this one is in the payment, expense, and cost chart. This is the one we have already studied. And this gross profit or economic result minus taxes is what we call net profit, the real profit the company got. Remember, business taxes are defined by law. Once we know all the different results that a company can calculate and all the different capitals that appear in a balance sheet of a company, we can calculate profitabilities. We are going to start with ROE and ROA. These are the two main profitabilities that a company can calculate. ROE refers to return on equity, and this is the equity profitability, and it's also called financial profitability. And ROA refers to return on assets, and it's a total capital profitability, and it's also called economic profitability. In order to calculate the return on equity, you just need to divide the economic result by the adjusted net equity. If you want to calculate it after taxes, which is also possible, you can do the economic result minus taxes divided by the adjusted net equity. Remember, taxes are business taxes, and these are defined by law, and at the moment in Spain, this is a 25% of the economic result of the profit. In order to calculate the adjusted net equity, you just need to do net equity minus capital grants, only capital grants. And if you don't remember clearly what is net equity, you can go back and check the balance sheet video where I explain everything in detail. But as a short reminder, you have here the formula. You need to add the corporate capital or the paid capital plus savings plus grants, all the grants, not only the capital ones, okay? Formula to calculate the return on assets, it's economic result plus financial interest, and these are the interests from the loans we have already studied in the payment, expense and cost part. So this will be the financial interest that appears as an expense in the expenses column, okay? So it will be economic result plus interest divided by net investment. You can also calculate this return on assets after taxes, and in that case you will do the economic result plus interest minus taxes divided by the net investment. And what's net investment? Net investment is going to be the result of total assets minus trade payables. Trade payables represent those amounts that the company has to pay to the suppliers, okay? And you also have to remember that total assets equals total liabilities. So you remember in the balance sheet, total assets, the left side has to be exactly the same amount than the right side, total liabilities. Depending on the information you have in the exercise, you may use one or another one. We're going to see now how to go from the return on assets to the sales profitability. This means how can we get the sales profitability formula from the return on assets formula. Remember, we have just seen the return on assets is the economic results plus interest divided by net investment. Remember that the economic result plus the financial interest was also called EBIT. So the formulas you have right now in the screen are exactly the same thing. You just have different names for the same thing. So the first step to go from the return on assets to sales profitability will be multiplying and dividing by sales. Remember, when you multiply and divide by the same thing, the formula does not change. Next step is exchanging denominators. So what we're just doing is taking the denominators from one fraction and moving to the denominator of the other one. Since we're multiplying, when you multiply things, the order of the things you multiply does not change the final result. So what we're doing should not change the final result. So at the end, we're going to have the EBIT divided by sales multiplied by sales divided by net investments. Doing this, we're going to have two different elements. The first one, it's what we're going to call sales profitability, and it's going to be EBIT divided by sales. Sales profitability represents the profit that the company gets for each euro of sales. Second element is what we're going to call the assets turnover, and this is going to be sales divided by net investment. When we talk about turnover, assets turnover, we're talking about the number of times that the company will recover the assets through selling products or services. And remember, when I say sales, I'm speaking about the income sales we have already studied when we were doing the exercises of payment, expense, and cost. And the last profitability we're going to calculate or learn how to calculate during this course, it's going to be the shareholder profitability. The shareholder profitability represents earnings that shareholders get when the company is giving dividends. So following that reasoning, we're going to divide the dividend per share, when you have just one share, the dividend per share, by the share price. And you need to know that the share price has two parts. It can have two different parts. One is what we call the par value, which is the regular value of the share, and second part is the premium. If you need to calculate the dividend per share, what you have to do is divide in total dividend by the number of shares. What happens if total dividend is not specified in the exercise, if you need to calculate it? Well, it's quite easy. The company can give dividends, but it has to do it after paying taxes. So what you have to do in this case is taking the economic result minus taxes and then apply a percentage that should be in the exercise. So the exercise should say something like, the company is going to give a 10% dividend. So you will do the economic result minus taxes, and once you have that amount, you multiply by the 10%. That way you're getting the total dividend. And then you divide it by the number of shares, and that's going to be in the exercise, so you get the dividend per share. And another missing data you may find is the par value of the share. So if you don't have the value of the share, you just have to divide the corporate capital or the paid capital by the number of shares. That way you get the share price and you can use the formula for the shareholder profitability. I hope this video helps you to understand what are profitabilities, to calculate them, and hopefully you will be able to use these formulas in the next exercises. See you next video.